I think we need to first appreciate that we're finishing 2025 on a difficult note with inflation having broken out again. We've gone through the disinflationary process now of the transitory impact of the pandemic. And now we're seeing cost push inflation re-emerge, not just in Australia, across the developed world to greater and lesser extents. But here in Australia, these recent inflation readings are very worrying. The end of the October reading, the headline CPI was 3.8%. And the outlook is for the RBA's trimmed mean number for the December quarter to come out at 1% for the quarter, or an annualised 4%. That is a long way above the 2.5% mid-target that the RBA uses. So in a higher inflation environment, we would obviously be avoiding fixed-rate bonds. They've already moved up quite dramatically over the past 3 weeks. The Australian 10-year bond at the long end of the curve has moved from a 15 basis point discount to the US 10-year to a 60 basis point premium, which is a terrific jump. That is mostly been due to the unwinding of the euro-yen carry trade and seeing Japanese selling about longing. At the short end of our curve, the move has been 50 basis points at the 1-year bond higher. That's a reflection of the higher inflation readings and the outlook and the expectation now that the Reserve Bank will be considering interest rate increases perhaps as early as the February meeting, but more certainly by the May meeting. And there are forecasts out there that expect 2 interest rate increases now next year. So that's one of the risks. The second risk in fixed income land is the credit margins as we enter towards the end of the year. Credit margins are incredibly tight, floating rate credit margins. They're tight at a senior level with 5-year major bank senior at 70 basis points and tier 2, major bank tier 2 5-year at 132 basis points. Now, to give you a little bit of an idea there, that blew out to near 300 during the Trust budget crisis in November 2022. So there is always a risk of something happening and credit margins expanding. Those risks are geopolitical, but they're also economic. We could, in an economic contraction, we'd see default risk rise and we'd see credit margins widen. So right at the moment now, there isn't a lot of potential alpha that can come out of being long either floating rate credit or fixed rate credit at the moment. So is there opportunity then for investors in that? I think the option value, the value is in staying at the short end of the curve, accepting a lower yield in the short term, so that there is an optionality there of taking advantage of a spike in fixed yields or an expansion in floating rate credit sometime in 2026. That's the opportunity. But in order to take advantage of it, we have to be patient and wait for this to happen. It's a time to be to be accepting lower yields and being careful.